We are looking at the NASDAQ here today. And we had our opening here. And there's a 15-second chart in lower right. We just traded through the new day opening gap of last Friday. So on the 5-minute chart, I have that in the left-hand lower corner. So we have our discount opening range gap right here. Midpoint is right there. It just so happens to be an old new day opening gap low in close proximity to that. So we'll see if we can get a little bit of a bounce in here, get up in the opening range gap. Change this back to electronic trading hours. So 474.50. 474.50 is where I'm focusing initially. So that way I'm not trying to force a bias. I'm not trying to have Caleb know for sure what direction to work within. First thing we do is we watch and see if there's any formation of a gap. We have a pretty respectable one this morning. Now let's look at the 1-minute chart here. I'm waiting to see if we get a fair value gap there. Again, the first few minutes of trading, let them have it. Let them do whatever they want to do with it. Whatever range they create, whatever expansion, whatever reversal, whatever is going to happen is going to happen. Now, 15-second chart. I like how the bodies have been respecting this new day opening gap. This is Friday's. Let's go to hourly chart. This wick right here. I'll show you. That one right there. Watch the 334.5 level. If we can go down there and touch that. Getting through that with a lot of momentum sets us up for maybe a run into that Thursday. And I'll not co-signing that one yet. We're just sitting still and relaxing. So we have our consequent encroachment level here. 1-minute chart. We have our first gap right up in here, real small. Right there, tiny little thing. That's all it takes though. So big give back today. There's the a medium impact news driver came out at 8:30. I could care less about the data in it. I don't worry about those numbers. I'm going to trust what the price is doing more than what the data is, because the data is always fluffed. If the market doesn't go where the data would indicate based on everybody else's opinion of it, for instance, if the data is supposed to be good for the economy or good for the market, and the market goes the other way, then they'll just say, well, it was priced in, but they didn't give you a report saying it's already priced in. So they're always going to explain it the way. So just might as well just look at price and see what's going to happen around the open. So far, we had a really good gap opening lower. You go back to regular trading hours. On the 5-minute chart. Don't want to do that. So still a very large opening gap. Just opened straight from Jump Street and traded lower. The sell side below here and that wick, that red level right here, that's this wick on the hourly chart, upper left-hand corner chart. If you're watching the price axis, you're going to be confused. Upper left-hand corner chart up here. It's the wick underneath my cursor right there. That middle of that wick is what I highlighted and told you to watch that. That's this same level down here in the lower left-hand corner chart. This is a 5-minute chart. We went below the sell side here, and we're trading inside of this gap. That's on the 12:50 p.m. from last Thursday. If you look at the 1 minute chart, that's real nice right there. Clean, equal highs, straight down right from the opening. So you know what retail wants to do. They want to be short. And we have a new day opening gap low here, just close to that mid gap. All right, some of the things I like to look for is like we went down below this low here, straight shot right from the opening bell. We have all these wicks in here, and generally, even if it is inside of this SIBI here, folks will look at that and think that that's something to go short on. I like the fact that it went down into that volume imbalance right here on the 1 minute chart with this candlestick here. And now I want to see, does it want to go higher to reach back up into end dog here and then maybe get up into the buy side there and see if we can get to mid gap, which is consequent crushing that red level up here. I got a little too many lines on the chart for my liking, so let me clean up. Go back into a 15-minute chart, upper left-hand corner. If we make another attempt to go lower, first of all, let's do this first. Let's cancel that out. I already outlined that I want to see it fail with this sell side and bounce buy side inefficiency. In other words, some of you, I'm going to maximize just this chart for right now, okay? Most of you may look at this like that and think, okay, it's gone up and it's rebalanced that out, so therefore it should sell off. Well, it can. I don't personally want to see that. I would rather see this one fail. That's what I'd like to see. I would like to see that one fail, meaning that since we went to the top of it here and here, if you split that inefficiency in half, I want to see it stay in the upper half. If it has any retracements, I don't want to see it go back in the lower half. Okay, so right away we're talking about how to look for fair value gaps that shouldn't be viewed as a shorting opportunity, because you would have been stopped or very close to being stopped out already. Because the rules are, whatever the fair value gap is that has the imbalance candle, there's always three, okay? There's three candles that make a fair value gap. Your eye is being trained, Caleb. For the most part, he can see these, but they're not always jumping out at him, because especially if there's multiple fair value gaps, okay, or what would be considered visually representing a fair value gap. Like he would look at this one and he would look at this one. And if there's multiple ones, it's like, which one do you use? It's the same questions that all of you are leaving in my comment section, the same ones that my private students sometimes they'll ask me. It's, you want a nuts to bolts. This is what you're doing. That's what we're covering this week. Okay. The whole week is going to be specific to that. But you have to let me talk about the details, okay? Because it's not just one sentence. There's going to be variations to certain things. That way, when you write them down, when you take screenshots, every time I draw attention, like I mentioned this one here, you should already have that screenshot. You should, let me get this out of the way. That should be screenshotted right there, okay? So some of you saw this one right here, and maybe you did take the short in here. And if you would have used the rules that a valid fair value gap employs, the stop loss would be above the number 2 candle in the 3 candlestick formation that makes a fair value gap. So if we look at it like this, 1 candle, 2, and 3. If the market has moved lower, this candlestick in the middle, that is your kind of like your trigger candle. That's the one you're watching to see stay open. This is number 1 candle. This is number 2 candle. Number 2 candle is where your stop loss is. That's your, if you're really trying to use the most leverage, not that that's something you should be encouraged to hear. I'm not trying to encourage you to over leverage. But if you're going to be using maximum leverage, you're placing your stop loss right there. The conservative stop, the number 1 candle is where your stop loss is. Okay, so right away, We've already cleared the air and removed all the confusion about where stop losses go and what candlestick is the trigger. If the market price is down below here and you're looking for lower prices, even still lower than that, if the market trades up, this candlestick, number 3, this is your entry. That candlestick's high, or one tick below it. If you're absolutely 100% certain that you believe strongly that it's going to drop, I will use a one tick below that candlestick's high. Now, you can do something like this. Don't worry, there's plenty of fair value gaps for me to trade off of. Just focus here first. We have to lay the groundwork. You'll see me pushing buttons today. Just sit your fucking ass still. The low and the high, that is your consequent encroachment of this hypothetical fair value gap. Okay? So this to this candlestick's high, that's your sweet spot. In a perfect world, if all things being perfect, this is your ideal entry point. Right in here. We've seen it go down into the lower half of this SIBI, which is a fair value gap that has a down close. It knocked out anyone that went short, traded down once more to the consequent encroachment, a mohawk, which is just coloring outside the lines, and trading up into that end all new day opening gap. And this is again Friday's new day opening gap. Right here, the liquidity is this. That's your buy side. And then up here is mid gap, or consequent encroachment of the opening range gap. And that's all that we need to worry about at this moment for you, Caleb. So we have a small little gap in here. Notice it's over here. It's the same thing, just going lower. So we have a fair value gap there. And we have a fair value gap right there. This, to me, isolates all this price action. So I view this as a balanced price range. I would prefer it not to see that fill in. It doesn't mean if it goes down and fills it and touches this candlestick's high or the small little volume bounce that has to be included. Like if you're drawing this fair value gap here, you can't just use the wick like that. That's not valid. That's not valid. You want to use the volume imbalance that's part of and inside of. What am I doing here? Okay, yeah. That's incorrect. This that's valid because you're taking in consideration that the difference between the two bodies, that they are not touching. So you have to have all the way down to the previous candle, or number one candle in this case, which is the opposite of this. Okay, so we want to see it trade above the end dog, come back down. It can use the top or the midpoint of that, spring from that up into the minor buy side, maybe hopefully accelerate and reach into that mid gap. And we still got about 7 minutes or so to see if we can hit that mid gap, because again, 70% of the time, it's not 100%, 70% of the time, mid gap gets hit within the first 30 minutes. So back to this discussion here for fair value gaps. We're not supply and demand. We don't trade in zones. So since number 3 candle, that is your entry candle. Number 2 candle is your framing of the fair value gap. What's the part that's the area where price should come back and revisit it? It's the candle that has no previous candles low touching the next candle after. In other words, in a perfect world, this candlestick should touch this candlestick and have a bridge between those two price points. But as we see here, it's being shown with just one candlestick. So it's one pass through or single delivery between this candlestick's low to where this candle makes its high. So as soon as the next candle, number 4, opens, you have a valid reason to anticipate a return back up into that fair value gap. It may not do so. It may just keep on dropping down. If it does, just let it do it. Don't worry about it, because your focus rather should be in the mid part of the gap that is framed by this candlestick's low and this candlestick's high. And if you drop a fib on it, same thing is accomplished when you put the little horizontal line on your rectangles. When you drop your rectangles in and you go to style, this midline is basically going to give you the same thing that you get when you put a Fibonacci on it and have the 50% level. It's consequent encroachment. It's the midpoint. If we're bearish, the ideal optimal entries are going to be formed at the lower half. Why? Because you want to see that upper half, this level up to this candlestick's low, stay open. You want that to remain open, because if it does, that means you have a very strong probability that you're right and you're going to be on side. And that's a fun thing to be on. And there's signatures that the algorithm signals to you that that's what it's trying to do. And you don't have to worry about it. You're not fearful of it. You're ready to smoke that minor buy side. There are specific price levels. This low of that candle number 1 to candle number 3's high. That's what I have a Fibonacci on, hypothetically, because these are just candles I drew out. They're not there. The same thing we're going to look at on the actual fair value gaps in price. But this is the stuff that you write down and you draw this out in your notebook, okay? You're welcome, here, get it out of the way. You're welcome to take that screenshot like that and then scribble all of your notes around that. But what you're looking for is, I personally, this is my favorite way of doing it. Because if you look at my charts when I'm doing executions, you might see where I'm just a little bit ahead of a fair value gap, or I'm just a little bit ahead of a bearish order block, because I know what I'm looking for. So I want to make sure I get filled, because I'm trying to trade in markets that are very heavy when I'm bearish, or very, very light and more likely to run higher when I'm bullish. So I want to make sure I get filled. I don't like missing my entries. I'm not worried about missing the trade. I have 81 ways to get into that same trade. But the thing is that you are not learning how to trade a zone. There's very specific price levels. And what are they? They're this. It's the high of candle number 3 when you're trading a bearish fair value gap. Look at that, buy side. Look at that. Who does it like this? Patrick, you watching? Take notes, brother. So that price right there, if it trades up into that, you can be short. I would be short 1 tick below this candlestick's high. And then if it trades up to the lower quadrant of this gap, I'm adding 1 more. What do you think I'm adding there? That's the 4 contracts. So I'm going to enter short. I'm not saying this is, let me slow down real quick, but I'm just teaching you by theory what you watch me do all the time in my examples. Okay, I'm doing this and I'm repeating it over and over and over and over again. And it's something that you're going to be able to do if you practice this. Okay. Entry 6 contracts at candle number 3's high, less 1 tick. If I'm not there at the time to get that on, as soon as it trades to this candlestick's high as it's happening, I'm going short rate the market. And then I'm watching price. I want to see price kiss that lower quadrant level that makes that fair value gaps range. Okay. I'm going to add 4 more there. And then whatever I feel comfortable with, if I get another opportunity to short, that'll happen if it touches consequent encroachment. If, and it doesn't always happen, if it trades up in the upper half, in other words, it does this. Now we're up in the upper region. Now I have a real deep discount. I'm sorry, premium. I'm trying to sell at an extremely high price. Then what I'm going to do is I'm going to toss in like 2 contracts, 2 more contracts. As long as it's spending time up in here and it keeps tapping, and if it shows the body staying inside of this candlestick's low, number 1 candle's low, I will allow it to wick through that. And it's okay for it to do that, because my stop loss is going to be resting 1 tick above this candlestick's high. It's going to take a real move to disrupt that. So we have this level here that we allow for the wicks to form through it, but we don't ever want to see the bodies close above it. We don't want to see that. So That's how I'm internalizing what I'm expecting when price is trading up into the fair value gap. My entry price point is specific. It's not, how do I get in this zone? How do I trade this zone? That's bullshit. We have to know what levels we're trading, okay? So if it's going to trade in above the midpoint and it's giving me a real high premium price, what price level am I going to aim for there? The upper quadrant level. The first presentation fair value gap right there. Let's highlight that. Every single time I annotate the chart, I got to start looking at the time down here. And if it's about to go to in the 50-second before the change of the minute, I got to wait for that to happen, because every single time I annotate the chart, it jumps. And sometimes, if I'm talking too fast, I won't notice it, and then my chart won't be like it's supposed to be, and it makes me angry later on when I see what my chart looks like. All right. I want to get that midline off. It's not what I want right here. Okay, so here's first presentation fair value gap. So same idea, just in reverse. When you're expecting the market to go up some higher price, okay, and you're watching price deliver, and you see three candles. One candle's moved and delivered price. The second one delivers price higher. That's key, okay. Then the third candlestick trades higher than number two's candle, but number three's candle's low does not touch or overlap with candlestick number one's high. That candlestick number two in the middle, that is your trigger candle. That is your fair value gap. If you're long or looking to go long in that instance, you're going to use this candlestick number three's low plus one tick. That's my entry. That's how ICT enters it. If I am watching it and it trades down and it gets into the upper quadrant level here, then I will add more. Again, this is just for completeness sake. I'm not trying to encourage any of you to build positions and pyramid. I'm not telling you to do that. Okay, I'm not doing that. So by having the market trade down to the upper quadrant and as low as the midpoint or consequent encroachment of this gap that separates candlestick number one to candlestick number two. This whole pattern here is this right here. This is candlestick number one, candlestick number two in the middle that's shaded with the blue box around it, and this is candlestick number three, this one. Okay, so in a full diagram, it's that candlestick right there is this one. So if we look at it like this, I'm going to elongate this and make it a little bit taller so we can see it. I already, in some people's eyes, talk too much, but I promise you, I've already taught you exactly what most of you have been wanting to know about how to trade fair value gaps and where to place a stop loss and how it should form. And that's what I'm here for, not the jokers that want to find something to talk about. So because we're using the volume imbalance here, that's how you would draw down to here, where I'm using the high here. If there is a volume imbalance, which is a separation between the previous candle body and the next candle that makes the fair value gap, that little separation, always include that. You'll have better determination of the consequent encroachment level, which is important. Like that's your most important level, because what you're watching for is you want to see the opposite of what I said earlier when we were looking at the sell or shorting opportunity for a fair value gap. We want to see the consequent encroachment in the lower portion traded to, and that's your best entry, because you want to see the upper half of it left open, and if it does, it means it's really, really bearish. Well, what do you think is going to happen on the times when you're bullish? The ideal entries are going to form in the midpoint of the gap to number three candles low, and you want to see that lower half stay open, not traded to. It can wick down in there. If it does trade to the midpoint, I'm going to add more. If it trades down to the lower quadrant, I'm going to add more. If I can see it touch this down here, I'm going to add more. I'm going to keep adding to that, because my stop loss is going to be below candlestick number two's low. Now apply that same logic over here. We did all this live, mind you. This number two candlestick, that's the fair value gap. The market drops down to this candlestick's price plus one tick. you would have been filled right there. The heat on that trade is your fill would have been approximately 404 and 3/4. We'll just call it 405. Say you got slipped. Okay, something happened. You got in there. You didn't do it exactly right, but you're in at 19,405 even. The low of that candlestick. See, I just see what happens every single time I go to a candlestick. It jumps. All right, so the low of this candlestick right there comes in at 401.75. So that's 3.75 handles drawdown. So 3 times 20 is 60. Just call it less than like 70 bucks. 70 bucks heat. If you're trading with one mini, that's how much drawdown you absorbed before it turned around and started going in your favor. And it went just short of what price level? That's that upper quadrant level. That price is 401.25. What is the low of that candlestick? 401.25. There is no zones, okay? It's very specific prices. We're looking for very, very specific things in price. Because if there is an algorithm, for people that don't believe there is, then it would be repeating the same phenomenon and respecting very specific levels that we can predetermine as favorable or unfavorable, right? Did it leave the lower half of that gap open? Yes, it did. It didn't even touch the middle consequent encroachment level. So what does that mean? It's bullish. So that means you can trust that once it gets into this little new day opening gap up here, it's going to do what? It's going to accumulate. It's going to roll higher. Cleared the minor buy side I gave you. There. And now it's accumulating. Again, we're sitting inside of a pool of liquidity here after taking this Judas swing ride lower. Consequent encroachment, we've missed the 70% rule, hitting it in the first 30 minutes. It doesn't mean just throw it out the window. It just means that it's most likely 70% of the time after 9:30 opening bell, if there's a large gap, middle of that gap, whatever that width of the gap is from previous day's settlement to the first opening price at 9:30, half of that gap, 70% of the time, gets hit by 10 o'clock. Here we don't see it. Since I've been doing the mentorship and taught it to you, we've seen 1 or 2 times where it hasn't done it, but eventually it gets hit. So you just got to relax and just submit to the idea that it's still on the table to be taken. Okay. Now, because we've spent this much time accumulating around the first presented fair value gap, look at the bodies. We wicked down through, but look at the bodies are showing you. It's respecting it, right? So if we can manage to get above mid-gap, I'd like to see it accelerate and move higher. Not just, I don't want to see it do this, like wick above it and come back down. I'm not interested in something like that. I would rather see it trade up above it and start building things like the fair value gap here, the gap in here. We went down and worked the lower half of this one, which I told you was going to fail. It wasn't going to provide a sell-off. And anybody else out there that thinks they understand imbalances and stuff, they may have looked at that and said, "Yeah, this is a short." It's not. Even though you were looking at probably all these wicks in here, and you call these dojis, Steve Nielsen's class of students would have been looking at that and saying, "Yeah, see, it's rejecting that." No, it's not. It's accumulating. It's accumulating. I'll show you in a second. Just relax. Let me get a drink. Let me go real quick over here so I can get rid of this diagram. The entries. My entry for a bullish fair value gap is I'm one tick entering above number 3 candles low. And if I don't find a way to get in like that, like say I miss it or I'm doing something, my wife gets my attention. My dogs got out like this morning. I had to make sure my wife could get Scout in because she's a little unruly. She's like the brat. Something keeps me from getting in the trade at that very moment. I would rather have gotten into it if I was watching the chart. And say the market is now just below it. As soon as I see it like that, I'm in it like that. I'm not messing around with it. I'm just marketing it. I need to be in there because that's what I'm looking for. Now, that might sound like, oh, you're rushing to get money. No, I'm rushing to get in something I already would have been in. It's not like I'm chasing where it's going up already. It's offering me a better price that I was willing to pay for a buy but I just wasn't there to capture that buy. So now I have the wonderful opportunity of getting it at a deeper discount. So I'm going to go and rate at the market. If it can touch the upper quadrant, I'll buy that too. If it touches the consequent encroachment, I'll buy that too. Anything less than that, I'm going to do 1 or 2 contracts. That's all I'm going to do. Because I don't want to build it bigger. Because down here in the lower half, I don't want to see it spend a lot of time down there, if it does that at all. The ideal scenario is when price is up here, and you expect it to drop down because you think it's going to go up into a longer, higher time frame target. Just use this example right here, because this is exactly what we're diagramming there in that little hand-drawn version of it. Take this off for a second so you can see. So this here is this. Trying to draw it, but it doesn't snap to the magnet draws the little drawing things, makes them jump to it. There we are. So in an ideal scenario, this is what this is. Candlestick number 1 is this candlestick right here. That's candlestick number 1 right there. That green candle. Candlestick number 2, which is the fair value gap candle, that's this one. And candlestick number 3 over here, that's this one. So that candlestick low plus 1 tick, in that case it would be 19,404.25. That's where I would be entering. That's all I got to get in. I got to get in there. And I don't care that I'm going to have a little bit of drawdown in this, because my belief is I'm not going to see likely any movement into the lower half of that fair value gap. So entries here, new entry there, or if you don't get that entry, if you I don't know, you're scared. You're just now practicing for the first time. Okay, and you see it touch the upper quadrant. Then go in and just do it at the market. But you want to do it as it's hitting it. When price is dropping into this level, in this halfway point of the gap that measures number 1 candles high, number 3 candles low, that range, half of that, everything from this price point, the midpoint, which would, in this case would be 19,365 and a quarter, to 19,378 even. Anything in that range is fair game to be a buyer, but not just any old price. Look at the quadrants. When you're grading an inefficiency, or you grade a wick, like I'm teaching you, there's a rhyme and a reason to what I'm teaching you. It's not. So the best buys are in that upper half of that fair value gap, because we want to see this portion in an ideal world, in a perfect world, in an ICT world. You want to see, this guy's arrogant. You want to see this right here. And then I got to take that midline thing off. And I'll get that to pop up. There you go. No, it ain't on there. It's the quadrant level. I'm sorry. So, yeah, ideal scenario is when we get another candle that drops down in this fair value gap, it's the upper half, the blue shaded area, like we have right here in this example. Any candlestick that drops down in there, we don't want to see it spending a lot of time in there. We want to see 1, at most 2 times, better if it's just once, entering it like that. And if you can start to run after going in just the upper half, feel confident that the lower half stays open for your benefit of knowing that you're on side. Now, does that mean you're never going to get stopped out? No, it just means that your confidence should increase, and your level of uncertainty or the trepidation that you feel about potentially getting stopped out with your stop loss down here below the fair value gap low, it should be minimized as it moves further and further and further away from the fair value gap. And you see this happening right here. And just look at the other lectures, the live streams from this playlist in 2024. I'm telling you that fair value gaps and anything that acts like an inefficiency, like a wick. If the wick is going to be bullish, we want to see the upper half of the wick keep price from trading into the lower half of the wick, regardless if the wick is above a candle's body or below a candle's body. It's the same thing. They call these wicks, and then below it's a tail. I don't even go that far. I'm looking at a wick wherever it's at. And if it's above market price, then that wick's going to be a premium array. If it's below price, then it's going to be a discount array. So if it's a discount array, the same thing I'm teaching you about the fair value gap, my PD arrays work with the wicks the same way. So this here is the same thing as this in a real market environment. Or as close as I can get it to appear as the crude diagram I drew out. There you go. So that's this, okay? And the entry would be as another candle comes down. And look how fast it did it here. That's also a clue. If as soon as the candlestick creates the fair value gap, if the next candle, number 4, drops in and they starts running, chances are stronger that this lower half will stay open. And you really will feel confident enough to, if you're recording it, you'll do the same thing I do a lot. I'll say, I want to see this stay open or remain unfilled. That's usually what you see me typing out when I'm recording my executions. It could be, a little bit of time before the market eventually comes back down into that fair value gap. And the same thing would appear in terms of the logic. So nothing changes there. But when they give it to you right away, that means it's going to be on a fast track to get somewhere quick. And that's the buy side I gave you over here. Okay. So this is also the lower quadrant to the opening range gap. And let's go down to the 5-minute chart real quick. And I'll pull this up. I'll show you what I mean by that. But previous day's settlement here, which is Friday, that's where we stop trading there. So you drop your fib on that. You draw it down to the first opening tick of the new day, which is right now 9:30. And that's where I drop the fib at. This level here is the lower quadrant. This is the midpoint or consequent encroachment. That's the level that 70% of the time in the first 30 minutes, it will at least touch that. It hasn't done it today, and that's okay. We don't need it to. In the upper quadrant level, and in the high, this is previous day's settlement. So we went above, spent some time here on the lower quadrant level. So back in the 1-minute chart, that's that lower quadrant level there. Okay, you see what it just went up there and it just hung around in that area. And then broke lower, traded all the way down and through new day opening gap from Friday. Again, that's the wrong date. And then here's first presented fair value gap after swiping below that new day opening gap of last Friday. And then trading up into that and then breaking lower, remaining heavy. Now we're back down into this inefficiency. Why did I tell you at the beginning of the live stream that this was not a shorting opportunity? Well, we had started the morning consolidating. This is electronic trading hours over here, so it's not regular trading hours. So it spent a little bit of time just meandering sideways, and then it broke initially right away. After it had already dropped from previous Friday's settlement price, we had already, if we would have opened back here at 9:06 or 8:49, that's significantly lower than Friday's settlement price. So we were already set up to have a big gap opening lower. And then if you have a lower gap opening that's in the cards, and then you watch the 9:30 time window come to pass, and now here at 9:30 we open and they just send it lower, that's a Judas swing. You don't ever want to chase something like that. When you start seeing the market create a swing low, this is your swing low right here. What's that? That's a candlestick right there, lowest candlestick that has a higher low to the right, higher low to the left, and then you right at that point, at that candlestick's close there, that opening, that's when I'm going back through all of this to look for inefficiencies, to look for order blocks, to look for anything like a short-term high where buy side would rest. Well, there is none of that in this. It's just a one straight shot lower. So that also is characteristic of a Judas swing. It's something fake. They're going to run right back over top of that. If you look at the range that was created on this drop, down to that low. Where is this inefficiency at? In other words, the thing I have shaded here, below this candlestick's low to this candlestick's high. This one single candlestick right there. That is a fair value gap. It is a SIBI, a sell-side imbalance, buy-side inefficiency, but it's in the lower half of the price drop from the opening bell at 9:30 to create that swing low. And I seen that as soon as that candlestick closed and this one started trading. I said, okay, this one here is fake. And they rally it up into that. And they give you these little dojis and make you think, wow, it's going to drop. And I told you, nope, it's not going to drop. I'd rather see it trade higher. And once it trades higher, it can come back down in, but stay inside the upper half. We just saw a mohawk right there. That's all we saw there. It didn't go down to the lower half once it left it, which is, that's the inefficiency model that I'm teaching you. That's how you know behind the scenes the algorithm is saying, all right, anybody that knows this information, quote unquote smart money, you're listening to them. They're going to expect that that's not going to trade lower. And then it starts to rally. Once it leaves this inefficiency, you have several things you can look for. A return back into the top of that inefficiency to treat that as a discount array. In other words, come down, hit it, and repel it higher. I'm going to take this off. Or, what do we have in price? What's in this area right here? What do you see? See that big wick? See this inefficiency first. Let me do this real quick. With the volume imbalance. The tallest wick right there. Watch. This candlestick leaves this inefficiency the way we were looking for it to do it. Higher, not lower. So it's failed because it's in the lower half. Now, if this inefficiency was all overlapping candlesticks, but then this one was there, then I would say if it got to here, then I would look for it to sell off a little bit. May not need to take out the low that formed there, but that would be one that could be tradable. And I'll show you examples of that today before we close. But here we have the consequent encroachment of this wick right there. So that means when this candlestick went up here and stopped, the next one we opened, it's reasonable to anticipate it to do what? Trade down to this candlestick's midpoint or consequent encroachment. To do what? To send price higher, because this is a discount array. And price goes higher. And then we get that fair value gap that we've been talking about all morning. What is this? We trade down into it, inversion fair value gap, sends it where? Lower. What color is it? Everybody knows what I'm teaching about inversion fair value gap is an orange hue. That means when it goes down through it, it's going to treat it as not as a buying opportunity. See, anybody else, if I would have had it like this, and I didn't say anything, you would have thought, oh, he's signaling that it's going to go higher. But what color did I hurry up make it? Orange. It's going to treat it as what? It's going to go down into this inefficiency, not to create a buy, but to fail. So again, if this is the only fair value gap that exists below the halfway point of that drop lower, and it's the fact that we dropped straight from the opening, that's what told me that gap is not something to go short on. It is something that you expected to go higher. That they think it wants to go where? Lower. And I'm telling you the logic is no, because right at 9:30 it dropped initially straight down, when we already was expecting a lower gap opening from Friday's settlement price. So it's already going to be opening at a real deep discount price. And then add to it, it opens and sells off that, and I run to the minor buy side in the direction of the halfway point of the opening range gap that need not be filled or delivered to, because you have an opportunity to take this trade to the first presented fair value gap. That could be your target. That would have been filled right there. What if that's all you decide to do, Caleb? Is there something wrong with that? No. There's nothing wrong with that. It's actually a low-hanging fruit objective, because the draw would be high of day, opening price, buy side, lower quadrant of the opening range gap, mid gap. They're all potential areas where a partial could be taken, or any one of them could be your terminus, your end target. So I'm providing you where the market's going to draw to, but you decide how you're going to frame it. Is it going to be the easiest one to get out of and be done? That's what all of you should do. Starting there. The easiest exit point that you can see, that you can comfortably wait for, and get in the easiest first opportunity, low-hanging fruit entry mechanism. And I taught that to you here today. Okay. Exiting, you're looking for the easiest exit. If you're expecting it to trade higher here, well, what's the first gap? That's this one here. The liquidity here, the lower quadrant, opening range, consequent encroachment, the midpoint of the opening range gap. The difference between Friday settlement price and the opening ticket 930 on this candlestick right there. Which technically, now that I look at that, I just made a mistake. And you're probably all saying it and screaming, and you're probably even tweeting it to me or leaving comments on my most recent post. That's not the first fair value gap, and you'd be right. I didn't look at the time. I'm sorry. It's my mistake. That's their very first fair value gap. So I apologize there. It can't be on your 930 candle. It can only appear at 931 or after. So this is your very first fair value gap. So I was incorrect by saying all that stuff. But then they had that, excuse me, you had the gap that we've been talking about that's inside that. So that's kind of interesting, isn't it? But the targeting aspect of what you're looking for, from where you expect price to run from to where it's going to gravitate to. In that first 30 minutes to 10 o'clock, you're always looking for an opportunity for it to try to get to the halfway gap. So consequent correction of the opening range gap, in my mind, that is my always first draw. I want to see that because there's a 70% chance that's likely to happen. If there's something before this level, like these smooth highs, the opening price, which is a static, it's not some zone, it's a very specific price level. If you aimed for that, that's a good level. And you have the first fair value gap here. So does that give you much room, leaving this area here where we said it live that this wasn't going to be a sell? It's actually something you want to see it trade higher from. It doesn't give you much room to profit, so that's not all that important. So because we're thinking it's going to go up to opening range gap, how can you use this inefficiency here? If you didn't look at the fair value gap like I outlined it when it was happening, and you were looking at this correctly, because I made the mistake of not recognizing that was the 930 candle. But I'm teaching as I'm doing it too, so it's a whole lot of things going on, and I'm doing it over a 1 minute chart. So it's not as easy as it looks, and if you think it is, do it. I'd love to watch your live stream. And I promise I won't troll you. The gap in here, this drop down into that fair value gap is also tapping into this gap, which is, if we're expecting it to go higher here, is this gap a sell? No. Why? Because the opening range gap midpoint or consequent encroachment is up here. It's still likely to be traded to. Here, what time is that? It's 9:48. What time is this candlestick when it would have gave you a buy based on everything we've been talking about in this live stream? It's 9:50. What is that? Macro time. 10 minutes to 10 to 10 minutes after 10. That's your macro. It's going to do what? Run to inefficiency or run to liquidity. Okay, well, we know that bias-wise, it's likely to draw up to half of the gap. Some of you, probably a lot of you, are looking at the fact that we didn't get there, and you're thinking, it doesn't work, it doesn't work. It's the draw. It's the direction, the first initial draw. How do you know which side of the market to trade on? I'm teaching that. It doesn't need to trade to these levels. 70% of the time is not 100% of the time. So how do you find something that's profitable in that model? If you see this as the first fair value gap, and I didn't even need to frame any of this on that. I was framing on the basis of watching this one form. So it just adds to it that is not necessary. But let's just say that you saw it as the first fair value gap, and we're expecting it to trade up to the opening range gap, consequent encroachment midpoint, and attack these smooth highs. Well, then you would expect it to trade through this gap here and do what? find the support, treat it as a discount array, and rally higher. At the time when we were watching it, we were looking at how these candles shared the same space between the two. One was offering it to the downside, one was offering it to the upside. So this is treated as a balanced price range. And the market rallies higher, attacks the buy side, the lower quadrant level of the opening range gap, and then did not trade to opening range gap consequent encroachment. But what did they leave here? What's up here? Now that's primary buy side liquidity. Why is this primary? He heard me. He's in my head. Because we cleared a higher high of the day. This is initial high day at 9:30. Drop Judas, rallies over top all that price action, reaches into lower quadrant, fails to get the opening range consequent encroachment of that gap, and then they leave high, lower high. That's a valid trap. So traders that are trying to go short, their orders to protect that short are resting right there. It need not trade it to it today, but you have to have that level as a key level until we go through it this week. That's a level that I have in my notepad. Give me a second. $19,463.50. If you don't have a pad, a writing instrument next to you while you're watching price action, you're doing it wrong. Because if it only appears inside your chart, you're not doing it right. Like, I look at the raw numbers when I'm done. Like, I'm away from the charts. I look at the raw numbers, and I think to myself how they might use it in the next session, which is the lunch macro. And then I look at how the numbers are used for the afternoon. And I formulate a possible scenario. Because I know this is the high of the day now, and they formed it with relative equal highs. We've broken this. This was initially what? Minor sell side. I didn't label it because I was actively teaching. But this has now been broken. So that minor sell side that would have been annotated as such, this now is primary sell side because it's taken out the initial low of the day. So here's primary sell side, primary buy side because it's taken out a high here, and this low is taken out here. So to take out this low is a much more meaningful event. It doesn't mean it can't soup it. It just means that it's a lot more meaningful how we trade around it. And I'll explain in a second. Give me a second. I'll have to annotate it. Bottom left. Alrighty. Now, because we've taken this low out with this drop down, we rallied up. Consequent encroachment of this gap over here. When we traded down through it here, you see how it offered it as a premium array and then sold off into this inefficiency right here. There. See that? Now that we're rallying above, I would like to see this now with the color that it is here. I'd like to see it be treated as a reclaimed fair value gap. So where we would have expected initially if we were not fully understanding what it is that goes on in the marketplace, the first time it drops into that, someone might think that, okay, that's one of those ICT buys, when that's the draw there. And we knew that when this was a inversion fair value gap earlier. We sold off from here to here into that fair value gap. That is a trade setup that I think that my son would do well with. It's a real easy bread and butter type setup. Now that we rally back above this gap over here, I want to see this act as an inversion fair value gap. It need not trade to it, But if it does, if it trades down into it, we can use that as a stepping stone to see if we can get to the buy side. That's a minor buy side right in here, right at those highs. And because you have this inefficiency over here, you want to drag that over too. And both of these areas in here, I'm going to watch to see if they can find some support at them or inside of them. Or if we quickly run into this down close candle here, this down close candle should not see its halfway point or mean threshold traded to. If it does, it's not good, and that means that most likely we're probably going to go lower and probably trade lower for the duration into the lunch hours. And where we're at right now, I would be more comfortable looking for it to try to trade up into that minor buy side that I have annotated here, because that would be a little stop hunt inside of the run from here down. The only time we've had a stop hunt, we've done it on this little wick. I don't like that. I want to see a bodied swing high, something like this, versus something like that, because we already hit that. We went lower. Excuse me. And then we ride back up. We haven't taken this high out yet, but we're respecting the lower half of this inefficiency. By definition, that's actually indicating that it's weak. So you have to stop and think for yourself, what has the most money been made on most recently? Would you say being long or being short? Because this is what you do when you trade the lunch macro. I'm going to be with you till noon today. So we're going to have just a little bit longer one today, and each day the rest of the week it will be shorter, because I'm just going in and taking 1 or 2 setups and then closing the session out, because that's what I want my son to do. Get in, get his, and go home. So yeah, we went down into half of this gap between this candlestick's high, that candlestick's low, and the bodies just went outside of that inefficiency's low over here. So it's left that lower portion open. So if we can, as soon as we trade above this high here, that cancels all this this inability to move to the upper half up here of this inefficiency. By me having all these things on my chart, which is what you're not used to seeing me do, you have to see the dynamic around how the market's operating in them. Otherwise, you're not going to fully appreciate it. And when you're looking at your charts and you're back testing, like I said, I prefer to see this inefficiency support price. I like the fact that we haven't broke down yet, but if it does, and the midpoint of this down close candle sets the stage for a run below that, I'm looking at these highs here as they're trying to trust or build in trust that anyone that's short, they're going to want to drop their stop loss down here. And if that happens to be the case, they may take out that low or this low and then run for that area, because it'll give them reasons to buy below this low. If they take it below that low, they can buy that and then start distributing those longs here, then here, and work inside all this range back up to new day opening gap. That's an order block right there. So since we tapped it, it needs to start delivering above here. Any failure to go lower sets the stage for a run lower into that, and then we could probably just keep dipping lower into it, into a lower daily range. So what I'm looking at is I'm seeing how we left those smooth highs. Mid gap is still up here, hasn't been traded to. We had a really nice short-term low that was priced in quickly. We folded, went lower, took that low out here. Failed to go lower there, but we're building this little clean area. This candlestick is to trigger whether or not we see it go higher or not. If it's going to go higher, I don't care about all the mess around here, and I can trade above this area if I want to go long to get this smooth high and consequent encouragement mid gap. If I'm aiming for that, if I'm bullish, that's what I'm aiming for. I don't have anything to do yet. I'm trying to stay with you long enough today to do something. I don't want to close the stream and not have pressed the button. That's what I'm doing. If I would have traded by now and took a trade and showed you where stop would be, where I'd look for it to run to, I would already close the stream out. But if it rolls through this mean threshold, this down close candle, that's this. If it's bullish, it shouldn't trade and go below on a closing basis. No candlestick should close below this mean threshold. It can stab through it. It can theoretically stab all the way down and match the same candlestick's low. It's bad. It's not the best for something like that to happen. But in theory, it can do that. Ideally, the upper half should keep price at bay and not go lower if it's bullish. But if it can keep going down and touch that midpoint, that's indicating that it's not something good. Now, what you're saying is what happens if you're buying that? I'm not trying to buy an order block today. I'm trying to trade the fair value gap. But I'm giving the logic around price action until a fair value gap forms that I would be willing to take. See, that violates it. And look how fast it accelerated through the bottom of it. What you're looking at is how I'm taking an order block to frame a displacement higher or lower. And that next price run, then I have to reassess and see what is it reaching for now that it's done this. Expecting it to fail, that's part of using the PD arrays because it gives you sit still or go the other direction. All right, so now we have the potential of this little fair value gap right in here. It's not there yet, but as long as we don't take out that low right in here, we might have something to work with. It might not be becoming an immediate rebalance. Immediate rebalance is coming right back to this candlestick's low. If it touches that, then the very next candle or that candle, usually we'll see it run in the same direction it was moving prior. Yeah, not much of a gap now. Yeah, I'd consider that immediate rebalance. I'm watching the wick in here. If it can stay in the lower half of it and not trade it above it or an upper half without taking out that high, it should roll right over and attack that low here. So if you were looking at this candlestick like I was outlining it, if it was going to be bullish, the upper half of that to the midpoint should be doing what with price? Supporting it. If it trades to its middle point, which is the mean threshold, it indicates it's weak. So now what happens when you start trading up into that same range here? It should stay in the lower half of this candlestick and then drop down and attack that sell side right there. So if you looked at this wick here, that's consequent encouragement of that wick. Halfway. So using the middle of the order block there and immediate rebalance, trading down to that, that's something that's tradable. So we've taken out the sell side here. Now here's the order block. This could become reclaimed order block, bullish, and run for the buy side here. I like this. If we can maintain that, it evaporated here. So let me get this out of the way. Get this out of the way. All right, so Caleb would have a low that's taking out that low over here, Now we have this low that was taken out here, and we have clean highs, an undelivered half midway between the opening range gap high and low that has not been traded to today. I'm drawing this, the gap's not there. I'm just saying if it closed now we have it. This candlestick's low that candlestick's low to these equal highs. That is definitely what? That's enough handles, right? And you start the clock from the time of entry. What time did you get in the trade? How much risk? This is the candlestick number 2. Stop goes below it. Here's your target. And you just watch. If it stops you out, you write down how long it took to get stopped out, how much drawdown you took on the trade that would be monetized, how much money did you lose, then how fast did it take, if it gets to your target, how fast did it get there? And you do this as many times as you can afford to do it in your study, that's all. The lower time frames will give you more opportunities so that we can do a lot of these types of exercises. It's not a matter of being right or wrong. It's a matter of desensitizing yourself to it. You don't want to be in here trying to be accurate on every single one because it's not realistic for you, Caleb. You don't know what you're doing. You're testing the theory. It's already tried to go lower by taking this low out here. This low was taken out here, but this low did not take out that low. And we have clean highs that could be easily trailed to for buy stops. So now what do you do with the information? This is what you do. I'm going to take these off because I want this chart to be clean. That would be a primary example of just a first partial. Okay? One partial. If you go to the next stage, say you've been doing these examples or exercises every single day for about 2-3 weeks, and you feel comfortable with it. You don't feel any anxiety. You don't feel any kind of nervousness. And you shouldn't really, because I mean, it's demo number 1, and you shouldn't be sharing those results. Not with me either. Don't email me your charts because I'm not going to open up your charts. I'm not going to open up your videos. Okay, I don't know what you're sending me. It could be a virus. I don't do those things. But the next stage of your testing and doing drills is that you would look for above here. What was the next liquidity? That's this one here. So this would be first partial. And then this would be terminus. That's where you're going to grow into, Caleb. You're going to look for a first partial objective, and then you're going to look for a terminus where you're done. And you don't need it to trade all the way up to that mid gap. You don't need it to trade back to its old highs and attack these relative equal highs. We don't need that. We don't need to see any of that stuff. So if you can frame the trade minimum, it's got to be able to move 20 handles. The range has to afford you, rather. I'm sorry, I didn't say that right. It's got to have at least this much movement potential where it can traverse from one price point where you expect to get in to where you think it's going to reach for. And it need not even go to that target. It has to afford you this much range. Now, we were down here, and I told you, try to hammer it with the market order. You're not going to get this price, as I'm going to show you here. So this candlestick's low. All right, look up here. It's this value right here. That is this candlestick's low. That's 339.25. So 19,339.25. That's the ideal entry. You're trying to get at that price plus 1 tick. So that would be 19,300 39.50. That would be your ideal entry. I'm off by 1.5 handles with my fill. Am I saying that right? I got to check myself here. Hold on. My actual fill was 342. So anyway, look at this from where we're trying to get in at. Right there. Come on now. There you go. I'm going to change that to green so we kind of flesh this out so Caleb can get a feel for what I'm talking about. All right. So what I'm essentially saying here is this is where I saw the price. Okay. I saw that price. The low is what I'm anchoring this 20 pip range, theoretically, is what that means. So if I'm aiming for these relative equal highs as a first partial target, Caleb, that means what I'm saying is this is where I want to hold my faith in seeing the price reach up to. I believe that the market could reach up to knock out the stops that would be trailed lower on anyone that's short. And I think I kind of explained that to you, and it should have been understandable. But now you can see how they did, in fact, do that very thing. So the buy side here is your initial draw. From where you're trying to get in at with that fair value gap, let me take this away for a second. And I'm going to take the execution off for a second. So from this candlestick's high, and that candlestick right there is low. Can you see that that's a fair value gap, but it's a buy side imbalance, sell side inefficiency. So if we think that it's going to go up here, and we have this one single candle all by itself, it's sharing no space, or let me say it this way. The space between this candle's high and that candle's low is not being shared in any other candlestick after it's formed. And then on this candlestick, it came down and touched this candlestick's low, which is 339.25. The next candle to the right of it is, see, every single time, every single time, that candlestick is the same price, 339.25. So that's why I just went in at the market, because it would have been my fill one tick above that, which is what? 339.50. But can you see that fair value gap is there? Were you here live when I was explaining it to you, watching it form? As soon as you see this candlestick close, the next candlestick, as soon as it opens up, my mind is immediately, bang, I'm watching that. I want to see that price tick. Once it books that price and offers it to me, mark it in. Plus one tick, obviously. So if it would have dropped down into the halfway point that makes this fair value gap, if it would have went down into the halfway point level, I would say hypothetically, this is where I would add, but I can't do it because I'm giving examples to Caleb to practice. He cannot do more than one contract. He has to do at least 2 to 3 weeks of doing this. And it's not about being right, son. I don't care that you take losses. It's not about that. It's about seeing it in the chart and engaging with it. Because everybody's losing trades in the beginning. Everybody's going to do it wrong in the beginning. But the way you learn how to do it correctly is this. This is it. What time is that candle? Oh, shit. That's the 1050, 1110 macro. Holy shit. What did you say about them macros, ICT? What did you say? They're going to do what? They're going to run for liquidity? Oh, shit. What is that? Oh, shit. What is that? That's somebody that knows what the fuck's going on. That's somebody that knows the future. That's the one with the authority. So sit your raving ass down. So right here, we have a very, very low drawdown entry. That's perfect. Perfect. Absolutely perfect. Over time, what you'll do is you'll see these gaps like this. And then you'll look and see if the number one candle has a wick. This is extra credit and no extra charge. If this candlestick, this wick right there to there, I'm going to take the quadrants off. This wick right there, consequent encroachment. You will learn over time trusting this, Caleb, but you can't trust it just the first few times that you see it. It needs to be months of it. You won't need to place your stop loss below the number 2 candle's low. You can use 1 tick below the consequent encroachment of that wick right there, because it's a gap. It's 2 layers of gaps. And it's already likely to only trade in the upper half. And if we see it trade down here like that and run up, if you started your stop loss there, you can roll it just below there. And then as you leave this high, then you can place your stop loss near the lower quadrant of the fair value gap. And that's this. In case you know what I'm talking about, it's this. You have to always grade your inefficiencies. Okay. And by grading, then what you're doing is you're putting the lower quadrant, upper quadrant in like that. Okay. So when you're bullish, the best perfect scenario is the market only drops in to the upper half of that gap and it leaves that lower half untouched. And that's indicating that it's extremely bullish. You're on side. You don't need to be afraid of getting stopped out. You don't even worry about your stop loss. It's there to do its job. What you're doing is you're watching price action deliver. Does it take this short-term high out? Yeah, it runs right to it. Opens. Does it overtake this wick quickly? Yep. Where's it drawing to? The liquidity I told you to. And it rallies up. And it consolidates. It's consolidating where? Inside liquidity. Inside the proximity of where these minor buy stops were. That's buy side liquidity. It's accumulating what? New longs to send it up into the minor buy side I gave you here. And they had this little move here. Now, I want to take you into a 15-second chart here. Have you ever seen ICT take a trade live? You never see ICT ever take a trade live. You never see him explain this stuff. This guy's a fraud. He is such a fraud. This guy is such a fraud. Don't ever, ever, ever listen to ICT, ever. Don't ever do that. All right, so here is the fill right here. Where's the little tick at? There it is. All right, if you look real close, right where I'm showing my cursor moving around, you'll see the little caret thing pop up right there. You see that? That's my actual fill. So the market opened on that candlestick and went down. I'm actually going to go into a 1-second chart. 1 second. Alrighty then. All right, so what we're doing is we're looking at that little tiny little candlestick right there. You see that? Right there. So from that entry on that candlestick, right at, we'll just call it the high, that one, okay? This is the lowest tick right there. That price is, what is that? 340.25. So literally 0.75 or 1.75. Less than 2 handles drawdown in seconds. In literally seconds of drawdown in terms of time. And then the market starts delivering in my favor.